If you're about 51 years old, have around $3.4 million saved, and want to retire at age 55, this video is for you. If you have a similar situation, you've probably been running the math yourself for years. You may have read books or talked to advisors, and somehow every source gives you a different answer. Some say you're set, some say you need another 8 years. Some focus on investments, others on taxes, but nobody has been able to put the entire picture together. So you keep working because at least that feels safe. And that's the exact situation that one of our clients brought to us not too long ago. Let's call him Marcus. Marcus is a chief revenue officer at a SaaS firm, and he's 51 years old. And he has about $3.4 million across his 401k and IRA, taxable brokerage, Roth IRA, and deferred compensation plan. And he wanted to step away from corporate at age 55 and spend $15,000 a month. So his question was simple: does the math work? Today, I'm going to walk you through exactly what we found, the gap the basic math misses, each strategy that we use to close it, and how to think about your own situation if your numbers are in this range. And if you're new here, I'm Dan Pascone, founder of Tailored Wealth. We help corporate executives in their prime earning years design a hybrid retirement plan that makes work optional on their terms. So let's get into Marcus's situation, the same way that we laid it out for him during our planning process. Marcus is 51 and he wants to step back at 55, 4 years from now. His target spend is $15K a month or $180K a year. We're planning to age 90, so 35 years of retirement. Here's how his $3.4 million breaks down today. $1.9 million in his 401k and IRA, $850K in his taxable brokerage account, $200,000 in a Roth IRA, $350K in a deferred comp plan structured to start paying out at age 57 over 5 years, and about $100K in a health savings account. He also has RSUs vesting at roughly $50,000 a year over the next 4 years. And his Social Security benefit is estimated to be $42,000 a year if he delays to age 70. Those are the inputs. Now, here's what the unplanned version of this looks like. With 4 years of growth and continued contributions, Marcus arrives at age 55 with roughly $4.25 million in investable assets, not counting his deferred comp. The shortcut that most people apply here is the 4%. So 4% of 4.25 million is about 170,000, but his target is 180K. That's a $10,000 gap right out of the gate, which doesn't look like much, but here's what the 4% rule doesn't show you. Marcus is retiring at age 55, and Medicare doesn't start until 65. That's a 10-year healthcare gap, and private coverage for a family can run $20,000 to $25,000 a year. Stack that on top of the spending gap, and the real shortfall in the early years is closer to $32,000 annually. The 4% rule also ignores how you draw from your accounts, when Social Security starts, when deferred comp pays out, and what happens if the market drops in year 2. Without a real plan, his portfolio could run dry in his late 70s. With one, the picture is completely different. Now, before we get into strategies, there's one foundational step that most people skip. They treat their portfolio like one big pile of money, everything invested the same way with no connection to when they actually need it. And that's a major problem. Money you need in 2 years should never be invested the same way as money you won't touch for 15. The framework we use is called life-driven investing. Instead of starting with an asset allocation and hoping it works, we start with Marcus's life and build the portfolio backwards. We organize his money into 4 liquidity bands. 0 to 2 years are his current needs, and we use cash and short-term instruments. At retirement, this is $404,000, 2 years of living expenses plus healthcare reserves. This money doesn't go into the market. It goes into high-yield safe investments, so it's there when you need it. 3 to 5 years are your short-term goals, stable, lower volatility instruments. In Marcus's case, it's about $540,000, covering spending while the deferred comp starts to ramp. 6 to 10 years is focused on midterm goals using a balanced growth portfolio. In this case, it's about $440,000, covering the years after deferred comp winds down, but before Social Security kicks in. And lastly, 10 plus years is focused on long-term growth. This is where the Roth IRA lives and where we allocate heavy into growth-focused equities and alternatives for additional diversification. For Marcus, it's about $2.87 million. And this is the real engine of the plan. And this structure is what makes every strategy that I'm about to walk through actually work. Without it, you're making investment decisions. With it, every dollar has a job description tied to a date and a purpose. Now let's get into the strategies. Number one is deferred compensation as an income bridge. Marcus's 350K deferred comp starts paying out at age 57 over 5 years. So 70K a year from age 57 to 62. And that bridge is important because it lowers the pressure on his investment portfolio during the most critical window. Instead of drawing 180K a year from his investments, in these years, he's only drawing 110. That's a 2.6% withdrawal rate on a $4.25 million portfolio. At 2.6%, the portfolio isn't just surviving, it's still significantly growing in most years. One important note, deferred comp carries real risk if the timing isn't built into your departure plan. It sits on the company's balance sheet. So building a payout schedule around your exit plan is not optional, it's essential. Strategy two is Social Security type. Marcus's default assumption was to claim at 62, and most people in his position make the same call. At 62, his benefit is approximately $26,000 a year. At 70, it's $42,000. That's $16,000 more a year, guaranteed, inflation adjusted for the rest of his life. If Marcus lives to 90, that one timing decision is worth $320,000 in additional lifetime income. And he can afford to wait because the income sequence is designed. The liquidity bands cover ages 55 to 57, and the deferred comp bridge covers 57 to 62. By the time Social Security kicks in at 70, it's providing a guaranteed income floor for the rest of his life, not filling a gap caused by poor planning. Strategy three is the Roth conversion window. When Marcus retires at 55, his taxable income drops significantly. No salary, no bonus, deferred comp hasn't started yet, and Social Security is years away. That 2-year window is one of the most tax-efficient periods in a high earner's financial life. We used it to convert approximately $200,000 from his traditional IRA into his Roth IRA. He pays taxes on that conversion during years where he's at the lowest tax bracket that he'll likely be at any other point in his life. And in exchange, that $200K grows and can be accessed tax-free with no required minimum distributions down the road. Once the deferred comp starts at 57 and his Social Security begins at 70, his taxable income rises and this window closes. In many cases, it's a one-time opportunity, so we made sure it didn't get missed. Strategy four is RSU coordination and tax loss harvesting. Marcus has 50K of RSUs vesting over the next 4 years, so a total of $200,000 of equity comp before he steps back. The default with RSUs is typically to vest, sell, pay the taxes, and move on. And this works, but it's not always the most efficient path. In his high income years, RSU income stacks right on top of his salary and bonus without any offset strategy. We layered in advanced tax loss harvesting from his 850K taxable brokerage account, selling positions with embedded losses to offset RSU vests in the same year. In years where bonus and vest overlap, we deferred what we could. In lighter income years, we harvested more aggressively. Over 4 years, that coordination saved approximately $65K in taxes. So that's $65K that went into his retirement portfolio instead of going to the IRS. Strategy five is asset location and the health savings account. Where you hold an investment matters almost as much as what you hold. Income generating assets like bonds and dividend paying stocks belong in pre-tax accounts where the tax drag is deferred. Growth-oriented equities belong in the Roth, where they grow and are eventually withdrawn tax-free. Tax-efficient index funds belong in the taxable account, where they generate minimal taxable events. And Marcus's $100,000 HSA deserves a specific mention. The HSA is the only account in the tax code that's triple tax advantage. Contributions go in pre-tax, grow tax-free, and come out tax-free for qualified medical expenses. We invested the balance in a growth-oriented allocation, specifically focused on healthcare costs in retirement, particularly that 10-year gap before Medicare. That's a dedicated tax-optimized pool designed for one of the biggest hidden costs in early retirement. Now, a plan that only works when markets cooperate isn't a plan. So here's what we tested. Market drops 30% in year 2. This is the scenario that ends under plan retirements. You step away from work, feel good about the plan, and then the market goes and drops 30%. And if you're pulling income from a growth portfolio at that moment, you're locking in losses permanently. For Marcus, the liquidity band structure eliminates this problem. His 0 to 2 year band is in cash and cash equivalents, and his 3 to 5 year is in short duration, lower volatility instruments. In a 30% drop, he draws from those pre-funded bands. So his growth portfolio sits untouched, it recovers, and he never sells at the bottom. This is what sequence of returns defense actually looks like in practice. Not hope, structure. The next risk we plan for, spending creep. 15K becomes 18K a month. Early retirement tends to cost more than people project. With the deferred comp plan running and Social Security delayed, the plan absorbs the increase. Marcus draws slightly more in his early 60s, but the model still clears 90 with plenty of assets remaining. Next is a very realistic risk that healthcare costs run higher than expected. Because the HSA is pre-funded as a healthcare reserve, overruns draw from that pool first, not the growth portfolio. So the plan flexes, but it doesn't break. So let's answer the big question. Can Marcus step away at age 55 with $3.4 million and spend $15K a month? The answer is yes, conditionally. And here are the three major things that determine if you're in the same position. Number one, your money is organized around when you actually need it. Not by account type, not by generic risk number, by time horizon, matched to the specific dates that your life needs cash. And that's the difference between a portfolio and a plan. Number two, your equity comp, deferred comp, and tax decisions are coordinated across multiple years. RSU vesting schedules, deferred comp payout dates, Roth conversion windows, Social Security time, all mapped together. That's where high earners either build a structural advantage or leave six figures on the table. Number three, your income sequence is designed, not assumed. When does deferred comp pay out? When does Social Security begin? When does Medicare kick in? Those dates drive the withdrawal strategy. And without them, you're guessing. With them, you have a retirement paycheck, not just a retirement balance. Now, this is one specific scenario, but the concepts still hold true, even if your numbers are a little different. Let's say you're 49 with $2.8 million. You have more runway for Roth conversions, coordinated vesting, and building the liquidity bands. More time in this phase is a major advantage. But if you're 54 with $3.8 million, you're likely closer than you think. The question usually isn't the balance, it's whether the structure behind it is ready. Because the framework doesn't change, only the inputs do. What Marcus walked away with wasn't just a retirement date. It was a clear model, a work optional target with real numbers behind it, a tax roadmap for the 4 years between now and age 55, and a portfolio organized around his life, not a benchmark. This allowed him to stop doing mental math and start making decisions. And if you want to run this same exercise with your actual numbers, let's have a conversation. I call it a wealth clarity chat. We'll look at your comp structure, your timeline, your investments, and map out what your version of this plan could actually look like. It's free, and the link to book is in the description. And if this was useful, subscribe. Every video on this channel is built for executives in their prime earning years who are serious about making work optional on their terms. I'll see you in the next one.